Welcome to The Explainer. We're all about breaking down big ideas into stuff you can actually use. And today, we are diving deep into the mind of a legend, Warren Buffett. We're going to unpack the core ideas from the Warren Buffett way to figure out what really made him, well, the greatest investor of all time.
All right, let's just jump right in with a number, 1.54%. Now, that might not sound like a huge deal, but here's what it is. It's the gap, the difference in performance, every single year between the S&P 500 and what the average person in an equity fund actually makes. And this is over 20 years. This is the painful truth of investing, you know? A gap like that over a lifetime, we're talking about the difference between a really comfortable retirement and, well, just scraping by. It can literally cost you hundreds of thousands of dollars.
And if you want to see that gap, really see it, look at this chart. It's just staggering. Let's say you put 10 grand into the S&P 500 back in 1965. Today, you'd have something like 2.4 million bucks. Pretty impressive, right? For sure. But what if you put that same 10 grand into Buffett's company, Berkshire Hathaway? Well, that would be worth over $380 million today. That's not just a little better, that's a whole different universe of creating wealth.
So what is going on here? How is a gap that big even possible? It's not about being smarter or having some secret inside info. Nope. It all comes down to a totally different way of thinking. Let's break down why most people lag behind and how Buffett just keeps on winning.
It really boils down to this one critical difference in mindset. See, most of us, we get caught up in a trader mentality. We're constantly reacting to the stock price bouncing around, scary news headlines, and just gut feelings. It's all emotion. Buffett, he's completely different. He has an owner mentality. He's not buying a little blip on a screen, he's buying a part of an actual real-life business. So he's focused on how much money that business is going to make over the long haul, what it's really worth. He could care less about the market's crazy mood swings day to day.
Okay, but here's the really cool part. Buffett's success isn't some kind of complicated magic trick. It's a system. A blueprint, really, and it's built on just 3 main pillars that are all designed to do one simple thing: find an amazing business and buy it for a fair price.
And believe me, this framework, it's almost shockingly simple. Step 1, you find a great business, one that's protected by what he famously calls an economic moat. Step 2, you check out the pilots, the management team, to make sure they're top-notch and on your side. And finally, step 3, and this is key, don't overpay. Figure out what the business is actually worth, and then buy it for a good price. All right, let's dig into each of these.
Okay, let's talk about that first pillar, because honestly, this might be the most important idea in Buffett's entire playbook. It's this concept of an economic moat. Think about it like an actual castle. The moat is what protects it from invaders, right? Well, an economic moat does the exact same thing for a company. It's a durable, competitive advantage that protects its profits from all the other companies trying to take a piece of the action. It's the structural advantage that lets a great business just keep winning, year after year.
And these moats, they come in a few different flavors. First, you've got network effects. Like Visa or MasterCard. The more stores that take the card, the more people want the card. The more people have the card, the more stores want to take it. It's this awesome, powerful cycle that just feeds itself. Then you've got switching costs. This is when it's just a huge pain to leave a product or service. Just imagine trying to get a big company to switch from Microsoft Office to something else. It's a nightmare. They're locked in. Some companies just have a massive cost advantage. Think of a company like Costco. They can just sell stuff cheaper than anyone else, period. Others are protected by intangible assets. The biggest one? A brand. The Coca-Cola brand is recognized all over the world. You can't just create that overnight. And last, there's something called efficient scale. This happens in markets that are just naturally small, where it only makes sense for 1 or 2 companies to exist, like the only railroad going through a mountain pass. Each of these creates a powerful wall around the business.
So, having a great moat like that leads us right into Buffett's second pillar, management. And while you think he'd want a genius CEO, this quote here really says it all. He wants a business that's so good, so strong, so protected by its moat, that even a total idiot could run it and not screw it up. Why? Because, as he says, sooner or later an idiot probably will be running it.
And that takes us to the third and final piece of the puzzle, the price you pay. This quote, it's maybe the most famous quote in all of investing. Price is what you pay. Value is what you get. The stock market is screaming a price at you every single second of the day. But that price, a lot of the time, it has almost nothing to do with what the business itself is actually worth. Your job, as a value investor, is to figure out that real underlying value, and then wait. You only buy when the price is way cheaper than the value.
That gap, that's your margin of safety. But here's the thing, and this is so important. You could master that entire 3-step blueprint and still fail. Why? Because you have to conquer the single biggest obstacle in investing, yourself. The real war isn't out there in the market. It's right between your own ears. So let's talk about mastering our own psychology.
Let me ask you something, and be honest with yourself. Why is it so gut-wrenchingly painful to sell a stock that's losing money? Even when you know deep down the company's in trouble and you really should sell. Well, the answer is a powerful glitch in our brain's wiring. It's a cognitive bias called loss aversion. Studies have literally shown that the pain of losing $100 feels about twice as bad as the pleasure of gaining $100 feels good. And because of that imbalance, what do? We hang on to our losing stocks, just praying they'll come back to even. It's a terrible, financially destructive habit.
And that leads us right into another mental trap. It's called anchoring. What happens is we get emotionally stuck or anchored to the price we originally paid for a stock. That number, that price we paid, it becomes the reference point for everything. But guess what? It's completely, totally irrelevant. The only thing that matters is what the business is worth right now, today. So you have to constantly ask yourself, am I making this decision based on some old price that's weighing me down, or am I focused on what the business is truly worth today?
Okay, so if the rules of the game are actually pretty simple, but our own brain is the biggest obstacle, what's the one thing, the one tool we have to fight back against our own worst instincts?
Someone once asked Warren Buffett what his favorite amount of time to own a stock was. His answer was just one word: forever. Now, that's not just some witty comeback. That is the strategy. It's patience. It completely changes the game. You stop trying to guess what stock prices are going to do tomorrow, and you start playing the long game, owning wonderful businesses and just letting them do their thing, letting them compound your money over time. And that really is what this all comes down to. The rules of value investing, the what to do, as we've seen, they're not that complicated. Honestly, anyone can learn this stuff. But the emotional discipline, the temperament you need to actually do it day in and day out when everyone else is freaking out, that is incredibly rare. So the real question for you isn't, can I understand the formula? It's, can I master myself? The rules are simple, but the discipline is hard. Which one are you going to choose?